wonderful, and to be here back in person for what I understand it's been a number of years since this conference was able to be held in person. First of all, I just want to make sure the mic is on and people can hear me and everything is fine. Awesome. So I really am delighted to be joining you for what I believe is the 22nd Annual Regional and Community Banker Conference. And people not here? Somebody, okay, awesome. So anyway, thank you all for being here. I also want to thank the team here at the Boston Fed. I hope you agree that they have really done just a great job putting together a really interesting program, and so that includes, of course, the Supervision, Regulation, and Credit Group, and also our New England Public Policy Center. So I did want to start by thanking them. And again, just delighted to have all of you here in person with us this afternoon. So, I know that we have representatives from banking sector members from across New England, which is also really wonderful. I have had the pleasure in my, I guess it's now 15 months or so, of visiting a couple of times all of the states in the district. I certainly intend to continue to do that, and I really learn a lot from it. It is extremely valuable for me and for the entire team to hear from stakeholders, from workers, entrepreneurs, small business, large business, local employers, of course, our bankers, community development experts, the civic center, civic leaders, local government, state and government officials, all of it, and much appreciated, and intend to continue doing that. It's really valuable to understand the infrastructure, the challenges, the opportunities throughout our district. And we also very much appreciate your constructive engagement with us here at the Boston Fed. It really takes all of us. We're just talking about working together in a variety of different ways. It takes all of us to support what I see as our overarching mission, which is a vibrant, inclusive economy that really works for everyone, and that takes us all working together. That's really essential. So what I'm going to do before going to the conversation and Q&A part of our time together is really to share some views of my own about the economic outlook, monetary policy, of course, and also provide some perspectives on banking, particularly focused on our region, and talk briefly also about the Fed's broader work, our broader portfolio across the region on banking and also payments innovation. Of course, before I start, I do have to give that standard disclosure. These are my views. I'm not speaking for anyone else here at the Boston Fed or in the Federal Reserve System. I do want to start with the economy and to highlight just the impact of some of the recent data, including data that came out this morning, on my views about the outlook and about monetary policy. And I want to recognize that some of the readings, some of the data that we've received have been a bit surprising, and that would include, for example, the stronger than expected September payroll employment numbers. And then we had CPI for September that was just released earlier today, this morning, and I'll talk a bit more about trends in inflation a little later in my remarks. So as you know, the Fed has a dual mandate from Congress for price stability and maximum sustainable employment, and our current focus remains on bringing inflation back down to 2%, the target, in a reasonable amount of time. Price stability is really essential for a well-functioning economy, and it's also an important precondition for maximum employment that's sustainable over time. And so the two parts of our dual mandate, the two pillars, are really intertwined. And reducing inflation impacts both parts of that mandate. High inflation really takes a toll on everyone. And as I've mentioned, I travel around New England, and I've heard over and over again about the toll and the challenges that high inflation causes and the challenges that people face. And that includes for households, especially our lower income households, are struggling to make ends meet. It also includes businesses who have to grapple with higher costs and the increased challenges and complexities of higher inflation related to planning and investment decisions. And so that's part of the why it's so important for us to be focused to restore price stability. So the battle against inflation is important, and it really is part of our public mission. As a result, the Federal Open Market Committee, or the FOMC, has raised rates, as you all know, rapidly relative to, if you compare it with the prior monetary policy cycles. And we shifted more recently to a more gradual approach this summer, and I want to talk a bit about that. We've made some progress in bringing inflation down, as I'll discuss, but it's really still too high. And given the persistent strength in economic activity, it's just too soon to determine whether the slowdown that we've seen in price growth will continue. So overall, I continue to believe that the current phase of policy really requires patience, allowing us time to review holistically the available information and to separate the signal from the noise in the data, and also to balance competing risks. A few weeks ago, the FOMC released its most recent Summary of Economic Projections, or SEP, and that reflects the outlook of the FOMC participants, all of the Federal Reserve governors and also the Reserve Bank presidents. The median SEP forecast is for inflation to near our 2% target by 2025-26 as the still hot labor market conditions normalize. Further, the median forecast sees the appropriate monetary policy to achieve this desirable outcome, involving an additional 25 basis point increase in the federal funds rate this year, and then holding rates in restrictive territory for an extended time period. This outlook from the SEP remains similar to my own. I believe that we may be at or very near the peak for this cycle, although I certainly would not take further tightening off the table at this point. And looking beyond the how high discussion to focus on the how long part of this tightening cycle, I will say that I expect rates may have to stay higher for longer than prior SEP forecasts had suggested. I do want to add that I continue, and I've said this repeatedly, and I think it's an important point to emphasize, I continue to be what I call a realistic optimist. And that means I'm realistic about the uncertainties and the risks to my baseline outlook, but I'm also optimistic that price stability can be restored with an orderly slowdown in activity and only a modest increase in the unemployment rate to cool the mismatch between labor demand and supply. So as you know, recent reports on real economic activity have been strong and overall demand remains resilient. Payroll growth jumped in September with upward revisions to job gains for both July and August. And although the average pace of job gains has slowed this year relative to 2022, it does remain above trend, actually well above trend. And since demand outstripping supply in the labor market has been a key factor driving wage pressures and therefore price pressures as well, some further rebalancing will be required for the deceleration that we've seen in inflation to be sustained. And with rates in restrictive territory, I do expect that payroll growth and economic activity more generally will slow down in the coming months. And there's already some evidence of demand and supply realigning in the labor market, even though it does remain strong overall. Unemployment is still at historic lows, or certainly very near historic lows. On the demand side, the previously very high voluntary quit rate has actually fallen back to pre-pandemic levels. Job vacancies have also been trending down overall, and they're a good bit below their peak, although they do remain elevated and surprised us with an increase in August. We're also seeing some promising developments in terms of labor supply. Labor force participation has actually increased, especially for prime age workers who are those aged 25 to 54. And since the second half of 2022, there's been a noticeable pickup in employment of foreign-born workers, and that's been helping to alleviate labor shortages in some areas. And importantly, despite the tight labor market, average hourly earnings growth continued to slow through September, especially if you look at a 3-month annualized basis, so focusing on the more recent data. And this is consistent with increased supply, helping to alleviate some of the wage pressures. These developments are promising, but to be sure that demand and supply are coming into better alignment, we'll need to see the recent labor market trends continue and broaden, including a moderation of hiring to a closer to trend pace. And this would be evidence of the sustained cooling in labor markets that's needed to bring inflation to 2% in a reasonable amount of time. In addition, strong job growth and the overall tight labor market continue to support consumption, which was quite solid in July and August. High-frequency data suggest spending may have slowed in September, but we'll have to wait to see whether this is actually borne out, and we'll get official retail sales data next week. Indeed, household expenditures have remained remarkably resilient so far, even in the face of the tighter financial conditions. This continued strength is also in part likely due to healthy household balance sheets from savings that was accumulated during the pandemic. These stockpiles are diminishing, but recent data revisions suggest the possibility of somewhat higher remaining excess savings than previously thought, which could continue to support household spending a bit longer going forward. Still, we are seeing some signs of consumers becoming more financially constrained as credit usage is rising and delinquency rates are increasing. So faced with high interest rates, it's unlikely that consumption will remain as resilient going forward. So turning to inflation, I want to focus on the core measure, which excludes the important but volatile food and energy components, since that core measure is typically a better gauge of the underlying trends than looking at total inflation. So whether measured by CPI or by PCE price index, core inflation has moderated. But a key question is really whether the recent progress will be sustained. The CPI release this morning is a reminder that restoring price stability is going to take some time. Disaggregating the key components of the measure really gives some valuable insights into what the different drivers are in the recent movements. Much of the positive news comes from declines in core goods price inflation, and that's been helped by the significant improvements in supply conditions. But firms' incentives to pass the cost savings from supply chain improvements through to prices could be short-lived unless demand slows. Housing or shelter inflation is moderating overall, but the September pickup in CPI shelter inflation highlights that progress can be uneven. In particular, we'll have to see whether the recent pickup in housing price growth will put further pressure on new rents, slowing the deceleration in measured inflation in the shelter sector. So that brings me to core services excluding housing, and that actually accounts for a significant portion of the consumption basket. Inflation for this component remains elevated, and frankly, overall progress has been limited. Bringing core non-housing services inflation down will likely require labor market conditions to cool more, as labor accounts for a large share of costs in this sector. So overall, it's too soon to be confident that inflation is on a sustainable trajectory back to the 2% target that we associate with price stability. And I'll also note that it's important not to read too much into any individual data point or even a couple of months of information. The monthly inflation data, for example, have always been noisy, but the variability of core inflation has actually increased since the pandemic. And so extracting the underlying patterns from data that really are quite noisy just takes some time. The mixed signals that we're getting from recent data highlight the need to focus on trends and take that holistic view to interpret the incoming information and determine implications for appropriate policy. And so here I'd like to just highlight the economic circumstances surrounding the pandemic and the recovery that really have been and continue to be highly unusual. Yesterday, during a Wellesley College event, I spoke at length about the role of uncertainty in policymaking, notably after an episode like the pandemic. And while the nature of uncertainty has evolved in the pandemic and this evolving recovery, there's currently a high degree of uncertainty about economic indicators, as I've mentioned, including around inflation conditions and employment growth. So as a result, this phase of policy really requires considerable patience. Policymakers need time to draw conclusions from the incoming data and to allow some special factors that have been supporting near-term activity, perhaps limiting the impact of the higher interest rates on the economy, allowing them some time to play out. And this includes the household excess savings that I mentioned earlier, as well as firms' elevated cash holdings and the debt that was previously refinanced at low rates. So as consumer savings and firm cash holdings decline further and more corporate debt needs to be refinanced, tight credit conditions should act to restrain activity, and we'll just need to continue monitoring these trends carefully. Since it's likely that we've yet to see the full effects of our past policy conditions, patience is also needed in order to best weigh the risk of inflation remaining persistently high against the risk of activity slowing more than expected. And I expect that higher short-term rates may place additional pressure on some banks' balance sheets and reduce bank credit provision more than anticipated. I also note that before the FOMC meeting at the end of this month, we'll receive additional important data on inflation and real activity, and that'll help me as well as the committee more generally in making our decisions. So finally, as we consider appropriate policy, I think it's important to take the movements in long-term interest rates into account. Since mid-September, the 10-year Treasury yield has moved up noticeably, though it retreated a bit this week. However, on net, this yield is now somewhat higher, as are corporate bond yields and mortgage rates. Several factors may be driving these overall gains in long-term yields, and it'll be important to see whether the increase is sustained, especially given the rate volatility that we've seen in recent days. Importantly, the rise in long-term yields implies some tightening of financial conditions, and if it persists, it likely reduces the need for further monetary policy tightening in the near term. This reinforces my view that we're very near and perhaps at the peak federal funds rate for this tightening cycle. So in sum, I believe the current phase of monetary policy requires patience and a holistic assessment of available data while we stay the course to restore price stability. I do expect we'll need to hold rates at restrictive levels for some time until we see evidence inflation is on that sustained path back to 2%. And patience will give us time to carefully separate signal from noise as we assess the data. And it'll also allow us to balance risks as the effects of tighter policy continue to work through the system. So I'd like to turn now from the national economy and just talk a bit about the regional economy, building from my colleague Jeff Thompson's remarks earlier today. In my travels around New England, I've heard about the unique challenges, but also about the economic strengths. I've learned about common threads that exist across much of the region. So some of the challenges that I hear are about things that prevent people from participating in the economy and in the workforce. And they include real economic issues like childcare, housing, infrastructure issues like transportation and broadband. And in addition, there are pockets of the region that face persistent social and economic challenges. And those gaps for people and for places are essential to recognize, and they can be hidden by overall aggregate data that may look favorable. I also hear about and see New England's many economic strengths, and among them the region's collective brainpower, a diverse and very skilled workforce, and an ecosystem of innovation. New England is home to world-class institutions and organizations in many fields. And additionally, we are very fortunate that job opportunities have historically been very plentiful in this region, although of course there's some variation by area. Another strength is the region's unique regional and community banking industry, and that's of course represented by all of you. Your banks serve households and businesses in communities large and small. Of course, banks face challenges apart from those linked to the current interest rate environment. And it's important, I certainly recognize that evolving customer preferences require increasing investment in technology, and that you're seeing increased margin pressures, and we just talked about that a bit, related to competition for deposits and also competition from new market entrants. I want to recognize the critical role that banks of all sizes play in creating a vibrant and inclusive economy. Community banks have remained resilient as they continue to leverage the close working relationships that they have within smaller cities, towns, and rural areas and across our region. Community banks provide critical sources of funding for small business, and this was particularly demonstrated, for example, when the federal government's Paycheck Protection Program was implemented, and community banks just played a major role in ensuring that those funds actually reached businesses. Fed Chair Jerome Powell has noted that a robust and dynamic banking system, along with effective and efficient regulation and supervision, helps to ensure that banks of all sizes can meet the needs of households and businesses in every community, in good times and bad. And I fully agree that we must preserve and build on these strengths and also on that diversity. For the final part of my remarks, I'll say just a bit about the Fed's activities. I like to say that our overarching mission is that vibrant, inclusive economy that works for everyone. And as you know, an economy's strengths has many dimensions. So the Fed has a broad portfolio of activities and engagements, and all of them are part of our public mission. It includes monetary policy making, as I've already talked about, economic research and analysis, bank supervision, financial stability work, serving as a lender of last resort for banks. We're also actively involved in community and economic development activities and initiatives and infrastructure related to payments, technology, and finance. And all of it, again, supports our mandate and our mission. I'll briefly mention some of our work to expand opportunities throughout New England so that everyone can participate in our economy. Since 2014, we focused on encouraging local efforts to bring economic revitalization to smaller cities and rural areas that have faced long-term struggles. This is an initiative that we call Working Places, and our approach is actually research-based, and it's based on research that shows an essential element of place-based economic resilience is collaboration among local individuals from different sectors who are willing and able to work together and share leadership. So over the past 9 years, Working Places has expanded to 30 communities in 5 New England states. The Fed's work in this initiative helps local collaborative networks emerge and flourish, and communities participating report solving problems, making changes that create opportunities and jobs, enlisting new voices and partners to help shape progress. Local teams develop goals and strategies, and some of the areas of focus are things like workforce development, poverty reduction, affordable housing, removing barriers to entrepreneurship. And the local tangible efforts are adding up to real strength across our region. And there are a lot of lessons that we are starting to learn from that work. Additionally, I'd like to mention the Fed's work in payments innovation. Since its founding, the Federal Reserve has played a role in ensuring that our country's payments infrastructure can effectively meet the public's needs. We demonstrate this commitment through continuous improvements in our financial services and by taking accountability for safe, accessible, and efficient payments. As you all know, the U.S. payment system is the way that consumers, workers, and employers make and receive payments, and it's evolved mightily, incredibly over time. It was just not that long ago that the Fed was actually helping physically move checks around to different places in the country. But we worked with the banking industry to digitize check clearing and create other automated channels. And just this past July, the Fed launched the FedNow service, a new payments rail to make instant payments secure and convenient. That work, of course, was led here in Boston by my colleague, Ken Montgomery, and the team, more broadly, again, with people from across the system. FedNow enables instant payments to be processed at any time of day, on any day of the year, for a broad array of transactions. And the FedNow service is a really core payments infrastructure that's available to all depository institutions. So in conclusion, I want to note that since its inception 110 years ago, and by design, the U.S. Central Bank has deep and varied interactions with banks and bankers, and of course will continue to do so. And those range from preserving safety and soundness to managing and improving our payments infrastructure to promoting access to credit that facilitates economic progress. So I and all of us here look forward to continuing that work together to support the people and places of New England and our nation with a vibrant, inclusive economy and financial system. And with that, my thanks for the opportunity to be with you today, and I look forward to the conversation, to your questions, and I think we're going to start with a conversation with Mike Ravid. So we'll shift to that. Thank you very much. How about if I sit here?
Good afternoon. My name is Mike Ravid, and I'm an AVP in the Regional and Community Supervision team here at the Federal Reserve Bank of Boston. For the next segment of the discussion, I'm going to be asking Susan some questions that we thought would be of interest to the community banking community, and then I will be sure to leave some time for those in the room to ask some questions as well. So to start it off, Susan, could you just talk a little bit about a broad question, just talking about your background, having spent many years in academic settings, just talking a little bit about what drew you to this role, and can you also share some reflections on your first year as president of the Reserve Bank?
Yeah, sure. So I did spend most of my career in academia, and in some ways it seems like that would be a very different role. But in fact, there are a couple of ways in which there's some real commonalities. This role really enables me to leverage, to use my background as an economist who focuses on monetary policy. I also have been a longtime educator, and I actually think of this role as having a key educational piece. And then I've spent quite a bit of my time leading an institution with a public mission, which is very much at the core here at the Federal Reserve. And I have to say that I spent many years as a director of the Federal Reserve Bank of Chicago, which introduced me to just the breadth of work that the Federal Reserve banks do, which was key. And I have to say the first year has gone incredibly quickly. A couple of takeaways. When I first came on board, I thought of this position, and still do, as a huge privilege. It's also a big responsibility, especially given the context and the decisions we make, and it's an opportunity, and I still feel that way. The focus on monetary policy at the moment, given all of the complexities, and I talked about some of them, really speak to the responsibility to work with the experts, and there's a wonderful group of experts to work with here. And so opportunity also to learn. There's a ton to learn, lots going on, and that's very important to me. I will also say that it's an opportunity to expand outreach and to make sure that we really are learning from people across the district. And it's been wonderful to come back to New England. I lived here 30 years ago, and my husband and I are really enjoying reacquainting ourselves with what is just a fabulous part of the country.
Thank you. No, it's a great New England weather day today. So jumping right into the monetary policy aspect, you talked a little bit in your comments about the summary of economic projections, or as we often call them in bank supervision, the DOTS. From the September meeting, it seemed to indicate that some members might be willing to hold rates higher, longer, possibly through 2024. You mentioned it in your comments, but if you could just talk a little bit more about some of the challenges that such a rate environment might pose for community banks.
Yeah, so it is the most recent SEP that I mentioned briefly in my remarks. The median forecast does have rates staying higher compared to previous SEPs, and I think the markets have responded to that as well. And of course, that elevated rate environment is related to the focus on bringing inflation down. At the same time, it is important to recognize the range of implications for different institutions, and we certainly think about that. As far as banks go, there are, in particular community banks, there are a number of things that are important to think about and recognize, many of which have already been talked about in this conference. So there are issues related to competition for deposits, and there's been quite a bit of discussion about that. There are interest margin considerations related to a higher risk and higher rate environment. And there are also the new entrants and different kinds of both opportunities and shifts in the marketplace that complicate an environment. And I think it's important to talk about those issues, to understand them, and conferences like this can help to do that as we work on them and understand them better together.
Great, thank you. And then the companion question to that, which you also alluded to in your comments, and Jeff also received a similar question earlier. With the release of the September minutes, could you just talk a little bit more also about the potential for an environment where rates might stay longer for higher on a more permanent basis, and just your thoughts on that dynamic?
Yeah, so let me say a couple things about that. I mean, again, the resilience we're seeing in the economy is part of the reason why, from my view, the rates are likely to need to stay high for longer. And again, continuing to monitor the data, being really patient because the data are quite mixed. Over the medium to longer term, there's actually a debate among economists in terms of the extent to which the underlying real rate is likely to be as low as it had been pre-pandemic, or whether a variety of other factors over that longer term may lead to that being elevated. And there's a range of views about that, and something that is important to continue to study. But it is, I don't think it's obviously clear whether the rate environment over the medium to longer term will be a bit elevated compared to where it was before, but it certainly is a possibility.
Okay, thank you. Just given the time, I'm going to ask one more question, and then for those of you in the room, please be ready. Just closing out questions with a question about credit, shifting gears slightly. While we haven't seen an increase in loan delinquencies or deterioration in credit quality at community banks, could you just talk a little bit about your thoughts on the current credit environment, specifically commercial real estate?
Yeah, so there are certainly important, this is an unusual environment, and there are some structural changes potentially that are important to bear watching. And so, Mike, as you noted, overall, we're not seeing the credit metrics suggest deterioration. At the same time, as things unfold, really carefully watching what's happening with some of the valuations. Again, not that we're seeing concerning issues overall right now, but there are many potential challenges as different parts of our region, but the nation more generally, kind of adjust to what could be structural changes that then influence the credit context and influence challenges and opportunities for community banks, which of course have large shares of their portfolios, particularly in some types of CRE. So there's somewhat more challenges potentially on the office side. So unpacking that a little bit is also important in terms of understanding what the trends look like.
Sure, thank you. We're seeing a lot of different dynamics in commercial real estate. So we have some time for some questions from the room. We have mic runners in the back. So if you do have a question, if you could just raise your hand and we'll get you a microphone. And if you could just identify yourself before you ask your question, that would be great.
Hi, Dr. Collins. Tim Thompson, Franklin Savings Bank. Any consideration of the bank term funding plan being extended beyond March of next year?
The bank term funding program?
Yes. Yep.
There has not been any determination about whether there would be an extension on that I can speak to at this stage. Certainly, there's continued monitoring in terms of how the program is being used and discussion about what might be helpful or appropriate, but I don't really have any details in that context.
Darrell Fest with Brookline Bank. Susan, the Fed has doggedly pursued its 2% interest rate. Is this a magic to 2% that we have to achieve?
So, so let me say a little bit about that. So I think about price stability as being a level of low, stable inflation where no one's thinking about inflation. And certainly we're at a place right now where everyone's thinking about inflation and has been. So obviously we don't have price stability now. And we saw over an extended time period that 2% really does achieve that kind of qualitative form of price stability. And from my perspective, if you are focused on achieving a goal, which we very much are, restoring price stability, you don't move the goalposts in any kind of middle of that campaign. And so I see 2% target as what price stability means. We've committed to that, and I think it's important, and to me that really does represent price stability. I'll also say that one of the very important things that I think the Fed needs is its credibility, and the investment in its credibility is one of the key ways that we actually do accomplish monetary policy through forward guidance and through the role of explaining what we're doing. And so as you think about all of that, that 2% target is very important.
All right, we have time for one, maybe two more questions.
Susan, I'll ask the other half of the dual mandate question that Daryl just did, and that would be, and I'm Clay Adams with Mascoma Bank. Full employment is defined differently, and our bank is predominantly in the northern states of northern New England, where Vermont and New Hampshire are less than 2% unemployment. So in some ways, we feel that more acutely than perhaps institutions or parts of the country that have higher unemployment from a price pressure, from a labor. There's all kinds of dynamics there. How is it that you bring that to bear at the conversations where it's not uniform across all these markets? And I know there's CDAC where you intake that information, but how does that play out?
Yeah, let me say a couple of things about that. So it's absolutely true that monetary policy is a national policy. And so when we make determinations about the federal funds rate, that plays out in financial markets across the country. But of course, it plays out in very uneven ways. And as you know, one of the ways that different areas of our region, much less across the nation, are different is the levels of unemployment rates, the industrial mix, in lots of different ways. So part of the structure of the Fed with 12 regional banks, as well as the Board of Governors in Washington, D.C., was crafted to try to balance how do you get information that really represents and enables you to bring together information from all of these diverse regions as part of the conversation to make a decision about what is a relatively blunt set of tools because it impacts the entire economy. And so that's part of why I take very seriously the responsibility to talk to different stakeholders across our region and to filter all of that as I think about the context I want to bring when I go to Washington to talk about what my view is about the appropriate policy. And that's one of the things that can be different as people are talking around the table because different bank presidents may have heard somewhat different kind of combinations of contexts from their own regions. One other thing I will say about that is that, of course, our portfolio here at the Boston Fed and for the other reserve banks as well is much broader than monetary policy. And so there are many other things that we do, such as the Working Places Initiative, that is much more place-based and that reflects the fact that there are some parts of our economy that are really thriving and just booming, and it's still extremely hard to hire. And then there are other parts that are really struggling. And so trying to understand those differences and talk with people both about the challenges and opportunities and finding ways collectively to address them is part of what we do.
All right, we're just about out of time, but if there's one more question, I think we can do it.
Julie Thurlow, Reading Cooperative Bank in Reading, Massachusetts. I think both you and Clay outlined the national implications as far as the economy is concerned, but now we have a lot of instability elsewhere. What are the concerns around oil prices, supply chain? We've got 2 wars going on. I don't know if you could talk about what risks are outside of the United States that we need to be keeping an eye on.
Yeah, so as I said in my remarks, I call myself a realistic optimist. The realistic part is recognizing the breadth of different kinds of risks and uncertainties that we continue to grapple with. And that's real, and that's really important. So one of the things we saw during the pandemic, especially the early phases, was this kind of networked supply chain disruption that clearly had significant effects in terms of our economy and in terms of, in particular, prices of goods. Things that are global in that sense impact our economy more than things that might be concentrated in certain parts of the world economy. So putting my international economist hat on, the U.S. is such a large economy that we certainly consider global factors, but some things that might be extremely important for a variety of reasons may not have as large a direct economic impact unless it lasts over time or except in certain sectors and areas. So we are certainly monitoring all of those things. Supply issues and global factors make a big difference, and we certainly saw that in the pandemic. And we'll have to kind of see how some of these other factors play out. The one other thing I'll say about that quickly is just yesterday, the remarks that I gave at Wellesley focus explicitly on uncertainty, 3 different types. One is the data are really uncertain right now. Trying to extract that signal from the noise is tough. Some of the linkages, like the extent, how long it takes for monetary policy to work through the economy, those long and variable lags, there's more uncertainty about that at the moment. And then the third type is these unforeseen events, geopolitical events, weather events, pandemic events. And all 3 of those have played a role and may continue to play a role. And so I think about a big jigsaw puzzle, and we're getting information about different pieces of it and making our best determination. But all of that, to me, is one of the reasons why, given all that we've done already, this really is a good time for us to be extremely patient and to look broadly as we gather the information and make thoughtful decisions to balance the risks, given the different impacts across the banking sector, across different sectors of our economy, and across different regions as well. Thank you. Lots of wonderful questions.
Great. So I think we're at a great pausing point. We want to thank Susan very much for her comments and answering the questions. I want to make sure I get everyone up to the reception on time. Everyone's invited up to the 31st floor for the reception, and we can continue the conversation of the day's topics upstairs.
Right. Thanks again for being here, and I hope you'll join us upstairs.